listening in to what myself and my colleagues are going to be talking about today. And as a matter of fact, I've invited a couple of our our folks that are from our team, and hopefully they'll pop in a little bit later and give you a view of. Hold on really quick. I need to handle something. Sorry, guys. All right, sorry. All right, guys. So I invited a couple of our other teammates to see if they can make it today. Maybe give you a little bit different viewpoint of the FX market. But I'm going to cover just what my feelings are this week. And my feelings are this week is we're kind of range bound, but we have to keep a really close eye on cryptocurrencies. And if you've been listening in to what I've had to say for the last couple of weeks, I'm really kind of focused on Bitcoin. And the reason why I'm focused on Bitcoin, and let me just explain that to you, and it has more to do with what's happening with the crypto market and institutions here, which will affect what's going to happen in the FX market, in my opinion. Bitcoin is one of those markets that, since it's been newly adopted by institutional money, we have to keep an eye on it rather closely, because if we start to see a sell-off in Bitcoin, it's going to lead to some, losses in, the institutional space. You have to imagine there's a lot of institutions that are buying and have been buying Bitcoin since sub 20,000, which would be down here. But they don't, a lot of these institutions, they buy them and they sit on it, but they don't necessarily just buy it and not sit on and not, take profits along the way. So, when you have this move that has, think about this really quick. Like, let's say you're buying Bitcoin and you're an institutional trader. You're buying in the 15,000 range, and you watch it come up to 64, 65,000. You have this pretty big position. You're like, yeah, man, I'm up huge for the year. And then, because you were up huge for the year, you probably, took some off the table. You started investing in different things. You taking some risk elsewhere. Stocks haven't been, really going anywhere. You're kind of getting whipped around in some of your positions, because it's really more of a stock picker's market, yada, yada, yada. And so then you start seeing like Bitcoin slide, and, what you had in profits, you end up losing 30, 40% from the highs. And now that starts to weigh on your P&L a little bit. So if Bitcoin really starts breaking below the 200-day moving average, which comes in around 40,000 right now, it's going to usher in some like systematic selling, from institutional systematic selling, that you get below 200-day moving average. It's going to start triggering some profit taking, and then you got to start watching about like how it could really affect broader markets. And so that's why I'm really, again, I'm focused on Bitcoin, because it's not because I really want to short Bitcoin or anything like that. I just think it is the ultimate risk on tool. It is the ultimate, I want to take on the most amount of risk as possible. I want to buy cryptos. I'm not saying that it's a risky investment. It's just from a risk management standpoint, it's going to be up there in the top 5 percentile of most risky things that you can invest in right now. Whether or not you believe Bitcoin's going to, 200,000 or back down to 2,000, that's not the point. The point is you're taking on a lot of risk as an asset manager, because it's an unproven asset, and it's still in the infancy, if you will, early stages, or hell, it could end up being in the late stages of Bitcoin's life cycle. Who knows? But what I'm trying to point out is if you start to see cryptocurrencies really come under pressure, Bitcoin would be the grandfather of that, or grandmother, however you want to look at it. You could actually see some other cross asset selling. That's why I think that Bitcoin's really important, and it has everything to do with currencies, fiat currencies, because if you start to see Bitcoin slide, that would probably equate to a rally in the dollar from a risk off point of view. So as far as the euro dollar goes, let's talk about the euro and where it's at. As I was telling our ForexAnalytix traders just a little while ago, I think the euro dollar is in a range, and I also said this in the week ahead video. By the way, if you guys are not familiar with the week ahead video that we do every weekend, just kind of an update. It's free. It's on YouTube. Just find ForexAnalytix and you watch the week ahead video. But as I mentioned there over the weekend, I'm actually looking for the FX market to identify what the next move is going to be, because I'm not confident at this point in time that I know exactly where the dollar is going to go. Usually I have an opinion and I don't mind voicing an opinion. But when I see the market as being range bound, I get to a point where I'm like, okay, let the market do the work for me versus me trying to figure it out. So when the euro dollar is, skating across this ascending trend line, that signals to me that, hey, as long as we're above that trend line, you gotta approach it with a more bullish flair. So that means that the euro dollar about the 120.85, 120.90 level is going to be really important support for bulls. But when you're talking about like resistance, I think that the euro dollar last week made a false breakout above these highs. So now we have to be really respectful of this resistance. And if you notice overnight, we couldn't even quite get to those highs. So what I think is happening is we have this range that is really between 122 and 121, roughly. Again, this is not technical analysis and support and resistance. It's not an exact science. If it was an exact science, then you and I would be multi-gazillionaires, because we know right when it gets to here, it will reverse and we're going to get long, and then it's going to always reverse there. We have to just kind of take a step back and say, okay, it's around these levels that are going to be really important. 121 or 122 roughly is going to be resistance, and 121 is below is support. We get much below 121, and especially like 120.80, and then that's going to be bearish. I think that the euro dollar is going to start to open up some downside, and the flip side of that is we get much above 122, and we're going to see probably a nice little squeeze higher. So keeping that in perspective, I think that we have to be respectful of the fact that we're in a range. But it's not just the euro. If you look at the sterling, we're stuck between the recent highs and then the breakout point, which is basically 140 and 140.150. You look at the Aussie, we're stuck between the false breakout here at 78.20 and then the support here at 77 cents or 76.80. I mean, we're like stuck smack dab in the middle in range city. Look at it. So you guys can have fun if you want and just kind of, trade inside of this range, and hopefully you don't get whipped around. But my opinion is you wait for the upper end of the range or the lower end of the range to get tested. You either, trade back into the range, or you wait for the range to break out and then you play the breakout. I wish I had a better feeling, but the way I'm looking at it is the FX market is going to be more affected by what happens in risk assets like Bitcoin Like if Bitcoin comes and breaks 42,000 today, I'll tell you the first thing I'm gonna do is I'm gonna buy dollars. Like if Bitcoin breaks down below and we start trading new 2021 lows today, I will buy dollars. That will signal to me that it's, risk off. Flip side to that is look at gold. Gold's at the 200-day moving average. We're slightly above the 200-day moving average. But remember, there's a lot of time left in today. Don't get overly excited that you're above the 200-day moving average right now. If you would have done that, on several different occasions, you above or below, you probably get whipped around. But we're above the 200-day moving average. We're right at the 618 retracement. And as Stelios, who he's going to talk here in just a minute, he was, at the descending trend line, he was pointing out, yeah, we get like above 1865. That's going to be pretty bullish in gold. If that happens, then you have to be a dollar bear, right? So you can see how I'm using gold and I'm using Bitcoin to really judge and figure out what I want to do with other currencies. Hold on really quick. Let me do something. I need to put in something in chat. Sorry, I'm just, we have, looks like we do have, looks like Steve and Stelios are here.
We are indeed.
Oh, I just asked the admin to upgrade you guys, and you guys are already upgraded. Sorry, for some reason I was and by the way, if you guys are listening, you guys listening in, we're using WebEx, which is FX Streets. The way it's the software that they utilize to host these. It's not the software that we normally use. We've been using Zoom for several years, even pre-COVID, like ForexAnalytix as a company. So we're more familiar with that and GoToWebinar that we used for the few years previous to this, to Zoom. So WebEx is a little bit of I don't know where everything's at. As I'm looking at the platform, it's not difficult to figure out. It's just knowing where to look. That's the biggest issue that I have. So when I was looking at you guys' names, I was like, Steve and Stelios, I was like, hey, could you promote them? But we don't need that. Okay, a couple other things I want to point out, and then I'm gonna pass it over to my colleagues, Steve and Stelios. And you can see some of these drawings that I did. This is from last week. I was and I'll continue this conversation from last week that I discussed with our ForexAnalytix traders. The volatility, I had mentioned that I think we're slipping again. These little spikes, you can see that they're finding lower highs, which means the volatility is probably going to go back to historic lows, back down here towards the teens. One of the things that I had mentioned last week, and I'm going to actually just stop here. This is where I wanted to be. I did this blog post on the S&P about the grind higher in risk assets, right? And one of the things that happened last week was the S&P broke we had like an ascending wedge here. The S&P broke, and I'm like, oh man, that's not what I wanted to see happen. I didn't want to see us break through an ascending wedge like that. What I was hoping would happen is we would see this rally towards like 46, 4,700, and then, immediately, let's say we rally 4 or 5% and then fall aggressively. That would signal to me that more of a that would signal to me that we'd see a bigger reversal in risk assets, and we would see a spike higher in volatility, like a much bigger spike higher. But unfortunately, what's happening is the volatility, is falling again because S&Ps are just kind of consolidating, and I think we're just going to continue to see the S&P just probably rally back towards, just kind of grind higher, basically, is what I'm trying to point out. I think we're going to end up just grinding higher, like we've seen. And that's going to keep volatility relatively tame. We'd have to break through some pretty key supports to see volatility spike, but because we're not getting a blow off top type of move, and we're just seeing the market just have 2 to 3% corrections, and then after 2 or 3% correction, we just continue on. That is supportive of lower volatility. And as traders, that's not necessarily what we want. As traders, we want to see bigger moves down that creates higher volatility, that creates more up and down in the currency market. And so that's what I was kind of looking at as far as volatility goes. And I think we've got to just, keep an eye on equities. It does look like every 2 to 3% correction that we see in the stock market is just being gobbled up again. Huh, Steve? Huh, Stelios?
Yes, absolutely. And
Agreed.
if you look at the bigger picture, I was saying this on our webinar for ForexAnalytix members just a little while ago.
Yeah.
It's a melt up, and nothing has changed. You get a few days of negative days in equity indices, but really in the big picture, nothing's changed yet. You need to see the dollar spiking, or you need to see yields going higher for me to actually think, okay, this might have, we might get some kind of a reversal in risk.
So that brings up another topic of conversation that maybe, Stelios, you might be able to take a few moments to talk about. Is something we were discussing this morning. You were talking about yields, and how do you think the move in bonds, U.S. Treasuries, or maybe even global fixed income markets, how's that going to affect what we're doing, or how equities are responding nowadays?
Yep, that's a good question and a very important one, because we saw last time yields tried to go higher in 2018. We saw equities and risk assets kind of wobbling a little bit. The thing is, we've had a decade of very, very loose monetary policy. Central banks basically buying everything that moves, including government bonds and MBSs and anything they can get, basically. So we've had really low yields all across the curve in most developed countries, and that's fueled risk assets a lot higher because you can borrow at near 0%, and corporations can raise debt at Apple, even Apple, who are sitting on billions and billions of cash. They just issue more debt, and what they do stock buybacks. So that's a way for risk to just get continuously going higher and higher. The question is, we saw the US 10-year yield break 150, which had been a pretty big level for a while, and now it's kind of consolidating above. If we do see a continuation, which I think we will eventually, even though central banks are going to try very, very hard to avoid that, I think then risk assets are going to be they're going to be vulnerable. Maybe not for a huge correction or for a long period of time, but I think if we do see, say, the 10-year move towards 2%, the 10-year bond is breaking as we speak, and I am short that. I have been short that for a little while. That's breaking lower, so yields are going higher. Definitely, this is going to be a headwind for equities and risk assets. That's for sure. And also as an extension, it's going to move the dollar. It's going to move commodity currencies. It's going to do all sorts of things to the FX market as well.
And that's the thing that I think you guys need to really pay attention to is this move higher in yields. It doesn't look like it's abating. And you got boons, and this is just the boons, which Stelios has been all over this for the last 6 months or so. We're now breaking multi-year trend lines. That means yields are breaking out higher in Germany. You've got the 10-year, and this is a chart I had up while Stelios was talking about, but I want to talk about this because this is a weekly chart of the 10-year yield. And what you've noticed is over the last 3 months, we have just consolidated. When you have this, and Steve would probably phrase it like this, and I can let him talk for a few minutes here because I'm gonna flip it over to Steve so he can show you what he's looking at. This looks like an impulsive move, meaning that it's a move that we should respect, and now we're consolidating. And it's not usually when you get the moves that look impulsive, if you will, they consolidate, and then you can say it's going to be a continuation type of move. So in this case, if you're looking at it more as like a kind of a flag pattern, I mean, it could tell us that yields are heading back to 2.25, which on a 30-year fixed mortgage in the U.S., you're talking about 5% interest, roughly, and at 5% interest, that's going to change the dynamic of the real estate market here in the United States and lending globally, really. So it's just something that I think that we need to pay really close attention to moving forward. So Steve, what are your thoughts here? And I'm gonna let you guys take over for a minute because
sure thing, Blake, but I think you need to pass the presenter, otherwise we can't share.
Yes, let me see if I can do this is the I'm gonna stop sharing, and then you might be able to take over.
No. In this program, you need to pass the presenter to somebody else. I think you need to right-click on somebody's name and make presenter.
Make presenter, yes. I just made
there
you
go.
Presenter. Look at you.
Thank you, mate.
You're welcome. Hey, and
if
guys,
I was Dale, I would say that I finally got a promotion, or so. What he's saying.
that hurts. Okay. You guys think I'm gonna let Steve take over, but Steve, what do you think about yields here and what can happen? I mean, going along with this conversation that we're having with and Stelio is talking about higher yields as well. What do you think here?
I think yields are probably breaking out. If not, the alternative scenario is that they need to consolidate a little bit more. Sometimes corrective moves are not very, very easy to predict how they're going to unfold. But what I'm seeing here is clearly a corrective move, which sooner probably, rather than later, is going to produce a resumption higher, which in this case is an easy prediction to make because either you see it from a technical point of view or a fundamental point of view. In both cases, we get the same type of signal that yields should be moving higher. Now, yes, Fed and the rest of the central banks and governments don't want yields to move higher because we have almost globally unsustainable sizes of debt. Irrespective of that, though, it's going to happen. What they're going to try to achieve, though, is help it happen in an orderly instead of in a disorderly type of way. Because if it starts accelerating in a disorderly way, that's definitely going to create, a chaotic market environment. Fear is going to take over, and it's going to break the precious bubble, which is called the asset markets, which is the main pillar to keep the pretense of
the Ponzi scheme going.
Pretense of a functioning economic model, which we don't have, not only the US, in the vast majority of the developed world.
Right. So what happens? What happens if yields continue higher? Do stocks eventually roll over?
Um, it mostly depends on real yields once again, meaning we know that inflation is, even the way they measure it, inflation has been accelerating higher literally by the month. Every single month we see a higher inflation print this year. So far, just by measuring what we've had in the first quarter, we get an implied inflation by year end of 6%. That is without even assuming that the accelerating trend of inflation, which we've seen every single month, is going to continue. So just by assuming that the next quarters are going to have the exact same inflation that we've had so far, we're going to see a 6%, but we might even see higher. So yields is one part of the equation. The other part of the equation is the actual inflation. So as long as real yields remain or move even deeper into negative territory, equities should continue to perform well in general. Now, at some point, of course, there is an end to every rope. So even if the move higher in rates is orderly, after it starts hitting some type of level that's going to be the breaking point for the market, yes, we might see a negative reaction to it, but it's extremely hard to predict in advance what that level is going to be, because in all actuality, it might be a combination of a specific level with something else that's going to be happening. You know how these things work.
Right, right. Well, okay. Well, thanks for the explanation, Steve. I'm going to sign out for a little bit, and I'm going to let you and Stelios take over here.
Absolutely.
Thanks, guys.
Thank you, mate.
Thank you, Blake.
Stelio, because I was doing some other stuff, you need to help me a little bit with. I didn't hear everything that Blake covered, so I don't want to.
No,
Hmm?
I'm kidding. No, so you mean about what Blake talked about in general?
Yes, and which instruments he covered, so we can go over some other stuff here.
We talked about a few things, a bit of everything, but he covered Bitcoin and he covered just a couple of the majors. We talked about the dollar and
Okay, yeah.
equities. So he kind of tried to cover all bases in terms of
Okay, good. So I'm going to start with the dollar, very briefly saying that.
Yes.
In my opinion, we're seeing another attempt of a breakdown in a clear downtrend that we've been into since March of 2020 in the dollar. And as long as equities remain well bid, there is no reason to expect that the dollar is actually going to manage to put in some type of a big recovery. So for me, the only thing that can help the dollar stay afloat is a breakdown in risk assets. Now, the benchmark for risk assets is globally the S&P, right? Because it's a rather broad index. It's the most liquid index in the world. So, what would I be looking for here? I would be looking for this ascending wedge that we see here in red. If we break down below it, if we break down below, let's say 4,000 roughly, then we open a door for a bigger corrective move in equities, and we open at the same time the door for some type of a relief rally in dollar, because those two should move in tandem. I mean, because it's a well-known inverse correlation. As long as that's not happening, in my opinion, we should keep looking in the same direction that we've been looking recently, having to do with dollar pairs, for example, the Euro USD that's attempting to break higher from this expanding triangles formation, the cable that has been definitely overperforming and doing really well for quite some time now. We should see an attack of the 143 resistance area, and we break above that, opens the door for more strength. In the case of the Aussie and the Kiwi, they've been consolidating recently, But in my opinion, you should respect this type of reversal moves that we've had roughly 14 months ago. I think they remain very strong as actual commodities do, because don't forget these are also called commodity currencies for a good reason, right? Their economies are sensitive to commodity prices. That's why, right? You see how strong the Canadian dollar has been by seeing how weak the USD CAD has actually been. How weak the USD NOK has been, because the NOK has been very strong. In my opinion, that vertical move higher at the uh, risk of phase of the COVID move last year was a move to be sold. We were telling that our clients in ForexAnalytix back then, and in my opinion, this was probably generational high up at 12.12. I expect that there is a very high chance that I'm never going to see that level in my life again. So I expect lower prices in USD NOK as well. In general, I expect all these currencies to perform over time very well against the dollar. Now, having to do with some real assets, gold at a very crucial juncture as we speak. We've been monitoring this descending channel for a long time, as you see, because gold topped out last summer, right at the beginning days of August, and we've been since in a move lower that clearly has corrective characteristics. I mean, compare the move to the upside, right, to the move to the downside. It took us a long time to retrace just a fraction of the move higher with some very choppy and overlapping price action, and probably we've now got to the point that we're about to break higher and begin the next leg higher for gold. So we're testing this this channel trend line resistance as we speak. We break higher and we confirm the break to the upside. And in my opinion, we're well on our way to new all-time highs in the price of gold. Equivalently, silver should follow, has a different type of correction, but again, a very corrective type of move. Platinum has also had a massive move higher. It's been in some kind of a complex correction higher, but lower, but in my opinion, that should end sooner rather than later. We've already had copper that pushed to all-time highs. Just remember, copper just 14 months ago was testing multi-year lows, and in 14 months of a non-stop rally higher, we went from $1.92 per pound to all-time highs, which is above $4.9, right? So, and
incredible move,
incredible. Yeah, it's like unstoppable move. I mean, once we got the first leg higher, I kept looking for a corrective move to buy copper, and the market is so strong that it never gave one, ever. So that tells you all you need to know about this. All you need to know. A market that doesn't want to go down is a very strong market. Here is crude oil, in my opinion, in some kind of a complex correction as well, toying around with resistance as we speak. I think sooner rather than later, this should also break to the upside and produce at least one more leg higher. I wouldn't be surprised if I find it actually very likely if within the year we'll be testing the multi-year high at $77, and just realize how easily the rhetoric changes based on price action. Remember all the negativity last year when the futures hit negative territory for a month, right? For just a few days actually of the month. And we've been saying since back then that this is an area that you should actually be buying crude oil, because the market being so negative at the moment is going to find market participants are going to find themselves once again in the wrong side of this market. And just look, within like 14 months, we went from if you want to look at the continues went as low as 11, and it has now reached roughly $70. So from 11 to 70 in less than 1.5 years. So all these trends technically speaking, are very strong and should be respected, fundamentally speaking, have a very, very good reason of happening, and that reason is called inflation. Right, inflation by the original definition, which is the expansion of the monetary supply, which has been unprecedented, to the secondary definition, which is the price increase that happens due to inflation, which we've started seeing happen, and clearly show itself lately. Gregor, is that you?
Yes, Greg is here.
Yeah, I'm here.
Oh, welcome. Join the party, mate.
Hey, you're talking so much that I don't want to interrupt. Okay.
Good thing
But
I noticed you.
here, as always, we are on the same line, as you know. So
Yeah.
Yeah.
So why don't you take over the charts and show us some?
You have to pass it on to him,
I
right?
know, mate.
Yeah.
yeah, yeah, exactly. You have to stop share, I believe.
Yes,
Or-
yes. Let me do it. So I'm to begin. I have to do two things to begin. Oh, somebody passed it.
Yeah, it seems so.
Okay, good. Go ahead, sir, and show us what you have.
Okay, so as you said, we are probably in these very strong trends that are not ready to be over yet. I just think that we are in consolidation phases here on some of the dollar pairs, and we are still very strongly moving higher here on stocks, as you said yourself, also on crude oil. So we are, at least I am expecting that dollar will see even more weakness, at least in the next few months. Firstly, I will look at cable. Now here is a very nice and strong uptrend that is now ready to continue after we have seen reversal from this lower trend line support that will trace also 38.2% perfectly for a wave 4. But later, maybe this was a triangle here in a wave 4. So I'm continuing to look higher here, especially if we pass this level where I labeled alternate count here. If we pass 1.4160, then I think that wave 5 could be in the cards for really maybe acceleration higher towards.
These, by the way, Greg, are the like hellish markets for amateurs. Amateurs have always the tendency of trying to fade the recent moves, and in this case, we've had in the FX slow but clear trends for quite some time.
Yeah.
And people don't get the opportunity to sell and make, sell these trends, try to play the counter trend and make money.
Yeah, I absolutely agree. So we definitely have to learn the lesson here and just
that you should always respect the trend. Yes.
Stick with the trend as long as you can.
Until proven otherwise.
Even if these are stocks, which in my opinion are way too high, but I think that there will be some retracements in the next maybe later this year when we may see a major corrections happening. But until then, we just should stick with the trend. So cable is also one example. You mentioned, I'm not sure if I missed this, you talked about Aussie.
Yes. I just, my problem with Aussie and Kiwi is that, this correction is very choppy for the time being. So, I'm not feeling safe yet to say that the correction is over and we're about to move higher, because we might have more of it, I think.
Yeah, I think that you're correct here. I mean, we're just chopping around. Maybe we'll form a triangle, but even if that's a triangle, we are just in the middle of this formation. So yes, we should be aware maybe even of another drop lower, maybe even
a lot of noise in this market, a lot of noise.
Yes, and then maybe we will stabilize maybe next month if we'll just continue to see this triangle to unfold, because waves D and E are still missing. But overall, I just think that this picture is very clear here. We came out of this downward channel very aggressively, so I think that higher degree pre-wave recovery is in place here, and for now we just should stick with the bullish for the first impulse here. Since you mentioned also gold, I agree here we are at very important level right now, and
Yes.
been tracking this WXY correction for a while. What
I
allows
think it's very likely it's broken, and you know why I think that? Because the GDX made the move first. The GDX has already broken out for quite some time, and the GDXJ followed. So you know, these make me very skeptical that the correction might have more to go in gold. I think that gold will probably follow as well, right? Imminently, I mean.
Yeah, I mean, for now, at least as it looks like right now, I mean, we were reversing from the lower side of this channel and also this trend line support. So we had seen a very nice bounce from these key support levels, 1670. And since we are now approaching this wave B of the second zigzag, well, that's your first confirmation point, actually, that we can be making a turning point, because you have this swing high broken. Of course, this 1875 is not out yet, maybe some short-term resistance, but if you look at the 4-hour chart, maybe this will only cap some upside for wave 3, then wave 4 pullback, and then even more gains, I assume, as long as we are trading, let's say, and we just stick with the basic technical analysis for now, as long as we are trading above this trend line. So I think that for now, gold is bullish, and any pullback, I believe, can be actually opportunity maybe to join this trend, especially if you're looking for longer time.
If you look at silver, it has a totally different formation, which in a different scale starts looking to me like a fractal of what the Aussie and Kiwi are doing. Meaning,
well, I mean, it could be maybe forming a triangle here.
Yeah,
and
exactly.
You'll see here pullback for a wave E, and at the same time, maybe gold will make that pullback for a wave 4, or maybe already higher degree wave 2. That would be even better. So in both cases, I think that after pullbacks, if there will be deeper, I think still there will be opportunity to see more upside. But I have also another wavefront here for silver, where this could be completed as a flat correction, where you have ending diagonal in wave C. So this is also a valid wave count, and could go very nicely with gold, actually, where both made the same timing of a completed correction back here at the end of March or start of April. So I think that we are going to see more upside on gold and silver, and I just think that if there will be pullbacks, as I said, if maybe silver is still going to just chopping around, there will still be opportunities after those retracements.
Perfect. Anything else you're looking at?
Maybe we can look just a quick look here at DAX. I mean, DAX is very bullish, and I think that we will see a break above these highs from 2 new all-time highs seen in April. So in the short term, maybe just keep an eye for anyone who is trading DAX, keep an eye on pullbacks. I would compare pullback to this wave 4 land, or maybe this wave B of this corrective recovery. So
I agree with you.
200-point move. This was also around 200
For some reason, the recent corrective formation in DAX gives me more confidence than I have on the S&P at the moment. It looks more clean to me.
Yes, and I mean, this is a very strong move for sure. So, but even maybe the S&P 500 will retest the highs, but still, as you said yourself, we have a very clear three-way drop here. So I labeled it as a flat correction. So I think that more upside could be coming, and especially if that would be your wave 1 and you will get wave 2. Let me label this real quick. So if we are correct here, then very nice support would be around 15,200, around there.
Yeah, previous high acting as support area now.
Yes.
Yeah, I totally agree with you. I was doing the weekend analysis yesterday, and you know, when I was doing the DAX, I was like, you know, this thing is breaking higher no matter what. You know?
Yeah, I mean, and it made a very nice and interesting reversal here, like it just spiked for a few points here below wave A, and then you know that this
the usual fake move that catches people you know, shorting at the worst possible moment. Yeah,
exactly. So that's it.
Perfect. What else, mate? Okay, that's it. Perfect.
Well,
Stelio, anything else before we call it a
No,
day?
I think we covered a lot of ground, and I don't have anything else to add. Thank you, Gregor.
Okay.
That was very
Perfect.
good.
Now, in case you don't know, all of us, Blake that spoke earlier, Stelios, Grega, myself, you can find us on ForexAnalytix. And you can also do yourself a favor and subscribe to our daily free webinar phase. So that we do what we're doing here on a daily basis every single day in the morning. We'll be glad to see you there. Thank you very much, everybody.
Absolutely.
bye-bye.
Thank
Have
you,
a
everybody.
wonderful rest of the day. Bye bye.